Los Angeles is stalling. Median home price $1.05 million, up 7% year over year. But homes sit 61 days on market, 10 days longer than last year. Zillow's value index shows a 2.4% drop, revealing a market coasting on momentum, not strength. Only 15% of California households can afford the median home. Rates hover around 6.27%. Insurance premiums spike, and buyers pause mid-deal. The engine that once drove California's wealth has shifted into neutral. How we got here? 3 years ago, Los Angeles real estate looked unstoppable. Between 2020 and 2022, prices surged as low interest rates, pandemic migration, and short supply pushed buyers to bid above list. Families relocated from expensive coastal tech hubs to the Valley and Inland Empire, chasing more space and remote work flexibility. But that boom left deep structural cracks. Inventory vanished, and by 2022, Los Angeles homes sold within weeks, some sold within days. Then came 2023. Rates doubled, insurance carriers pulled out, and new listings froze.
Around 20% of new apartments built in Los Angeles between 2020 and 2024 were located in downtown LA. That's a 30% drop from the last decade.
By mid-2024, a market once defined by frenzy began showing fatigue. Fast forward to 2025. Statewide home prices are up barely 2.2% year over year. But growth has slowed sharply. In Los Angeles City, the median sale price still sits above $1 million. Yet the number of homes changing hands has thinned. Buyers hesitate, sellers cling to peak-era expectations, and the average home now lingers 61 days before closing. This isn't a crash, it's a freeze. The data reveals a city where confidence and liquidity are evaporating at the same time. Builders delay projects, lenders tighten underwriting, and families that once raced to buy now rent and wait. The result is that Los Angeles is still expensive, still desirable, but far less active. The volume that sustained record tax revenues and political calm has evaporated. Who's still buying? In today's Los Angeles market, only two groups are still moving, and they're polar opposites. On one end are cash buyers, often investors or downsizers who can sidestep high mortgage rates altogether. On the other are high-income professionals willing to pay record sums just to secure scarce listings in West Side or coastal neighborhoods. Together, they now account for roughly 1 in 5 purchases, while first-time buyers have nearly vanished. The data shows how the middle class is being squeezed out. With rates above 6%, even modest homes now require $200,000 plus annual income to qualify for financing. FHA and VA loan volumes have plunged, and lenders report lower pre-approval traffic across Los Angeles County. Meanwhile, institutional investors who once flooded the market in 2021 have quietly scaled back, citing thin rental yields and higher insurance costs. Flipping profits are near 17-year lows, making speculative activity rare. Rents are steady but no longer climbing fast.
Law has removed parking requirements for projects located within a half mile of major transit stops. The motion would apply that law to the entire city of LA, including commercial developments.
The average LA apartment lists for $2,500 to $2,800, with vacancies near 5%, suggesting renters are holding ground instead of buying. It's a tale of imbalance. Those with cash or equity still play the game, while average households remain locked out. Coverage and premiums jam the gears. Even for those who can afford a home, a new hurdle has emerged: insurance. Over the past year, Los Angeles buyers have faced delays, cancellations, and shocking quotes as major carriers reduce exposure. State Farm halted new policies, and the state-run Fair Plan, the insurer of last resort, is pushing for a 35% premium increase. What used to be a $1,500 annual policy now often exceeds $4,000 in high-risk zip codes near canyons or hillsides. Lenders require active coverage before closing, so when insurers pull back, deals fall apart in real time. Agents across LA report escrows freezing for weeks as buyers scramble to find coverage. Wildfire risk maps now stretch deep into suburban areas, forcing families in otherwise safe neighborhoods to pay premiums once reserved for rural zones. The ripple effect is huge. Sellers are pressured to cut prices or offer credits to offset the higher costs. Appraisals get tricky when insurance adjustments alter buyer budgets. And for existing homeowners, renewals are unpredictable. Non-renewal notices arrive without warning, leaving thousands scrambling for alternatives at double the cost. This insurance gridlock doesn't just slow sales. It undermines confidence. A market can survive high prices and high rates, but not uncertainty about basic protection. When homeowners can't insure their biggest asset, every transaction becomes a gamble. The 2025 cost stack. The numbers behind today's Los Angeles housing payments explain why the market has stalled. In 2020, a buyer could lock in a 30-year mortgage under 3%. Today, that same loan sits near 6.27%, doubling monthly payments even if the home price hasn't changed. A median-priced LA home now costs roughly $1.05 million, which means a typical borrower faces a $5,900 monthly bill. Once mortgage, property taxes, insurance, and HOA fees are added. That's 82% higher than in early 2020. The California Association of Realtors says only 15% of households can afford the median-priced home statewide. In Los Angeles County, the qualifying income has crossed $230,000 per year, 3 times what most households earn. Even buyers with solid credit and 20% down struggle to meet debt-to-income limits, forcing many to reduce budgets or leave the market entirely. Hidden costs make it worse. Insurance premiums have doubled in some neighborhoods. HOA assessments keep rising to cover aging infrastructure. And new city-mandated seismic upgrades add thousands more for condo owners. Together, these factors turn once reachable homes into long-term rentals for the middle class. Liquidity crunch. The slowdown in Los Angeles isn't just about prices, it's about movement. Homes are sitting longer, buyers are hesitating, and deals are collapsing mid-escrow. According to Redfin data, the average days on market has climbed to 61 in the city and 55 in the county, up sharply from last year's 40s. Sellers who expected bidding wars are now cutting prices quietly, hoping to attract the shrinking pool of qualified buyers. Across Los Angeles County, inventory is up 26% year over year, the biggest jump since before the pandemic. But more listings don't mean more sales. Escrow cancellations are rising as insurance complications or appraisal gaps derail closings. Some buyers walk away after realizing their insurance quote exceeds their monthly car payment.
The average rate on a 30-year loan 1 year ago was at 6.35%, and as more buyers are holding on to their cash, sellers are getting just as frustrated with the sluggish market.
The city's sale-to-list ratio now hovers near 98%, down from 100 a year ago, showing that sellers are conceding but not panicking. Still, the liquidity that once kept this market fluid is drying up. Without confident buyers or flexible lenders, the pace of transactions slows to a crawl. When deals stop in hours, when the Los Angeles market slows, it doesn't fade. It freezes. All it takes is a single shock, a wildfire advisory, a new flood map update, or an insurance carrier's withdrawal. Overnight, pending sales can vanish. Earlier this year, when insurers briefly paused new coverage in several high-risk zip codes, dozens of escrows were suspended within days. This instant freeze isn't rare anymore. In early 2025, wildfires swept through foothill areas, damaging homes but also freezing rebuilds. By fall, city records showed only 782 of 1,843 rebuild permits approved, proof of how bottlenecks and bureaucracy can stall recovery for months. Even neighborhoods far from direct danger feel the shock. A single natural disaster elsewhere in the county can spook insurers, forcing statewide reevaluations and blanket moratoriums. Sellers who thought their closing was days away suddenly wait weeks. Inspectors delay appointments. Agents relist homes that are already sold. ULA, regulators, and friction. Policy friction is now one of Los Angeles's biggest hidden drags. In 2023, voters approved Measure ULA, a transfer tax on high-value properties meant to fund affordable housing. In theory, it targets luxury sellers. In practice, it's reshaped liquidity citywide. Any sale above $5 million now carries a 4% tax, and those above $10 million pay 5.5%. UCLA research shows listings above those thresholds are now 50% less likely to sell than before. The ripple effect runs down the ladder. Move-up sellers hold off, mid-tier inventory never hits the market, and construction financing for new multifamily projects dries up. Developers face their own maze. State housing mandates push for new units, while city permitting backlogs and rising fees slow them down. Regulators argue over rent caps, seismic codes, and energy compliance, each adding cost and time. Lenders, meanwhile, are more cautious. They price in wildfire exposure, insurance delays, and policy risk, reducing the flow of credit that once fueled the city's construction boom. Stress to resilience. Not all of Los Angeles is slowing at the same pace. The stall is uneven. Some zip codes are bending. Others are quietly breaking. On the west side, high-end neighborhoods like 90049 Brentwood and 90210 Beverly Hills show value drops of 3 to 4% year over year. Homes there still list above $3 million. But days on market have nearly doubled. In downtown LA, where condos once drew investors from overseas, values are flat, and listing discounts of 5 to 7% are now common. Head east to Silver Lake and Echo Park, and the tone shifts. Prices have held roughly steady, supported by limited inventory and young professional demand, but sales volume is down 20% from last year. The San Fernando Valley tells another story. Family homes in Sherman Oaks and Encino remain in demand, yet average time to close has stretched past 50 days, with insurance costs adding $200 to $300 per month. Further south, in Inglewood and Hawthorne, affordability keeps activity alive, but thin margins make financing fragile. Meanwhile, coastal pockets such as Santa Monica and Manhattan Beach stay the most resilient. Values are flat, but cash purchases dominate nearly 1 in 3 sales. Across these sub-markets, the pattern is the same. Price tags still look firm, yet liquidity is disappearing. The higher the risk or the tighter the financing, the faster the freeze. What it means now. Los Angeles isn't crashing, it's pausing. The signs of rising inventory, slowing closings, and record insurance costs show a market gasping for balance after years of extremes. Mortgage rates near 6.27% and affordability at 15% mean most working families are priced out. Builders have pulled back, issuing fewer permits and waiting for clarity, while insurance hikes continue to choke buyer confidence. For anyone trying to buy or hold, the next 6 to 12 months will be about patience, not panic. Lock rates early, secure insurance quotes before bidding, and expect longer negotiations. Values may stay flat, but pressure on affordability will not. This isn't the end of the Los Angeles housing story. It's the reset before the next chapter. And for California's middle class, the question now is simple. Can they hold on long enough to catch the rebound?